Alright, so in today's video we're going to break down QQQ Invesco's Trust. This is an ETF that has been around since 1999. It index tracks the top 100 NASDAQ index. It is an ETF in equity and large cap growth tech stocks. Now, why would you hold this? What this does is gives you broader exposure. Instead of just having the S&P 500, you are able to add to your portfolio by having focused technology and consumer discretionary sectors with major holdings such as Apple, Microsoft, Amazon, Google, and many others. This is a growth-oriented strategy. And now let's break it down. Let's go on Fidelity and look at QQQ in more detail. All right, so let's break down QQQ, the Invesco QQQ Trust. This is an ETF that follows the top 100 NASDAQ companies. Look over here on the right side, almost 51% out of 100 companies is Apple, Microsoft, Nvidia, Amazon, Broadcom, Meta, Tesla, both Googles, and Costco. They make up 51% of this allocation. So definitely very tilted towards technology. Now, when you look at it real quick, you can see that the gross expense ratio is 0.2%. So you're paying a little bit higher of a fee to have exposure to these technology companies. Just to show you, the asset classification is U.S. equity stocks, passively managed, large growth. This fund has performed very well, and it's very volatile when the market has increased volatility. So as you can see here, 102 companies, top 10 that we just reviewed equal 51%, and we'll review the other 90 companies that are within it, but they make up 49%. North America is 97%. Market cap is giant, large, and 10% into medium-sized companies. And I want you to see the sector exposure of 49% tech stocks, communication services 16%, consumer discretionary 15%, staples 15%, healthcare 5%. So you can see that this is technology focused ETF here. Now, going back to the distribution expenses, your dividend you receive, it's smaller than the S&P 500, which is around 1.17% a year. This tech QQQ ETF gives you 0.54% dividend yield for owning shares, and you will pay a 0.2% expense ratio. Now, when you scroll right to the performance and risk, looking at your $10,000 investment from 2014, your $10,000 investment in 2014, it's now 2025, would be worth $55,000. So when you look at the life of this fund, it has earned about 10% each year, but it does have more volatile years because in the last year it earned 26%, 13% over 3 years, and in a 5-year period earned 19.76%. Now let's compare it to its competitors. QQQ, which is the one that we are reviewing right here, 0.2% expense ratio. Fidelity has their own NASDAQ version of it, which charges a little bit more, 0.21% expense ratio. You have QQQE, which charges 0.35%, QQEW 0.57%, and that's why I made this video on QQQ, because it is the lowest expense ratio that you are going to get when you're looking for just the top 100 NASDAQ technology companies. To see the other 100 companies that are within this, we reviewed the first top 10. Looking at the other 90, you have Netflix, and then you have the weight allocation on the right side. So you have Netflix, T-Mobile, Cisco, Pepsi. Feel free to take a screenshot of this. I just want you to be able to be aware of what is in this fund. And it's all technology-based companies basically making 50 to 51% of it. That's the end of the video. If you like what you saw, definitely check out the playlist. You click on the playlist, go under Fidelity. You can get the different index funds and ETFs that revolve around QQQ, S&P 500, Dow Jones, etc. And there's much more on here. Just go through the playlist. You'll see different